I think value investors are going to have a harder time now that there's so many of them competing for a diminished bunch of opportunities. So my advice to value investors is to get used to making less.
Like his famous Berkshire business partner, billionaire Charlie Munger isn't one to shy away when it comes to bluntly expressing his thoughts. Just late last year, the nonagenarian called out whiny investors who were mumbling about the economic challenges at the time, saying their discontent was irrational. People are way less happy about the state of affairs than they were when things were way tougher. It's weird for somebody my age, because I was in the middle of the Great Depression when the hardship was unbelievable. To put things into perspective, the Great Depression, which started in 1929, saw unemployment reach a peak of 25% in 1933, coinciding with a 29% decline in real GDP over 4 years. So, given how the current state of the economy is nothing close to that, and that the unemployment rate in the US stands at 3.6%, it's quite scary to see Charlie Munger say this.
There are times that are easier and there are times which are harder.
So is right now tougher just because valuations have come up so much?
Of course.
So you think
A, the valuations have come up, and B, the competition sorting through those opportunities is more intelligent and more aggressive and more numerous. Of course it's harder.
Do you think that the
net result is people are going to get worse results?
Have you ever heard the saying, "A word is enough for the wise"? If you're a follower of Munger's teaching, you should be aware that he hardly ever offers the same advice twice. He's always clear and astute with his words, with sharp precision. So, you can imagine how surprising it was to hear him repeat himself in a recent interview, as he did for the Acquired podcast.
We're in the opposite of the cigar butt era these days. Are there opportunities out
somebody
there?
will find a few things, but it gets harder and harder.
We don't mean to sound like a doomsday clock, but he also said it's going to be harder for the present generation to get rich at Zoomtopia in October, according to a blog post on Zoom's website. But this brings us to a burning question. Why exactly is Charlie Munger so worried about the climate for investors? And also, isn't there anything we can do about it? To answer the first question, we need to break down what Charlie is so concerned about with 3 focal points. The first of which is a harder environment we find ourselves in. You see, as interest rates increase, companies begin to face challenges in repaying loans and acquiring debt for rapid growth. These difficulties typically impact profitability, subsequently influencing stock prices, and funnily enough, this marks a significant departure from the expansive conditions witnessed in the past decade, characterized by a rise in virtually all sectors. And this brings us to the second reason why it's so difficult to become an investor nowadays: risk-free rates. Keep that in mind. With increasing interest rates, newly issued government bonds provide more attractive returns. In a high-interest rate setting, a substantial amount of institutional bonds tends to shift from stocks back to the security of bonds, creating challenges for stock appreciation. The third problem is the oversaturation in the financial analysis of the market, which was explained at a recent Berkshire Hathaway shareholder meeting.
There is so much money now in the hands of so many smart people, all trying to outsmart one another and outpromote one another, getting more money out of other people. And it's a radically different world from the world we started in. And I suppose it will have its opportunities, but it's also going to have some unpleasant episodes.
In the early days of Charlie and Warren's investment journey, financial data and the stock market in general were not so easily accessible. The shift only came when investors began to experience significant gains and technological advancements over the past 3 decades, making the market more accessible and, by extension, giving the stock market a true gold rush. Make no mistake, this newfound ease in investing created more analysis and scrutiny of publicly traded companies. And when you pair that with how easy it became to get in and out of positions in basically any major market around the world, why wouldn't there be a saturated environment? And guess what? The reason why Charlie Munger is pointing out that saturation is the issue is that it has now made it difficult to find amazing investment opportunities frequently. In a nutshell, Extensive analysis has made it almost impossible to find high-quality businesses at a bargain. Just look at this.
99, what is something that you believe today that 70-year-old Charlie would have disagreed with?
I think I knew when I was 70 that it was plenty hard, but it is just so hard. I know how hard it is now. It's not a bit easy. It's very hard. There was a lot of low-hanging fruit in the early days of our operation. You don't have any low-hanging fruit that is easy to recognize.
You mean in investment opportunities?
Yeah, that's right.
Just in case you're currently panicking, rest easy for a bit. We know 2024 might be challenging for many investors, but thankfully there is a silver lining.
No opportunities whatsoever. I think you're just saying low expectations and fewer bonanzas.
Now the beauty of it is you only have to get rich once. You do not have to climb this mountain 4 times. You just have to do it once.
Well, that's sort of your philosophy on both sides, is you got to be patient for the great opportunities, but you got to recognize them when they come and pounce.
There aren't many times in a lifetime when you know you're right and you know you have one that's really going to work wonderfully. Maybe 5, 6 times in a lifetime you get a chance to do it. And people do it 2 or 3 times early, all go broke because they think it's easy. In fact, it's very hard and rare.
We know it sounds a bit cliche, but Charlie Munger is absolutely right. Staying patient while waiting for the right time to strike is your best bet in the era we're in now. Both Munger and Warren Buffett believe in value investing. And the thing about this style is that the best chances only come around a few times in a lifetime. It may sound disappointing, but make no mistake, focusing on a golden opportunity every decade is far better than settling for mediocre investment opportunities every other day. Remember when Warren Buffett said this?
It's going to get tougher.
That was Charlie Munger speaking at the Berkshire Hathaway shareholder meeting earlier this year. I was there, sitting alongside tens of thousands of people listening to Charlie warn us that we're heading into the toughest period of investing that he's ever seen in his lifetime. Now, normally, Charlie isn't the one to say things twice, unless it's something he really wants people to understand. That's why I was quite surprised when this topic came up multiple times again in a recent interview he did for the Acquired podcast.
Well, of course you do. It's very difficult to invest money well, and I think it's almost impossible to do time after time.
Imagine you've only got a punch card where each time you make an investment, you make a hole in it. And once you've gotten to 20, you're done. You'll be amazed by how good you'll live with a portfolio made of only good decisions. It's one of the best ways to think about investing, because it means you really want to wait for those big opportunities. And guess what? The reality is that good opportunities only come a few times a year. Just walk with us here for a minute. From the day you were born until now, how many big opportunities have you seen strike big on the stock market? Realistically, there are only 3. The first of which is the dot-com crash, then the global financial crisis of 2008, and finally, COVID-19 in 2020. That's 3 times in just about 3 decades. Remember, Warren Buffett attributes much of Berkshire's success to around 12 exceptional investments, despite having made numerous others, both exceptional and mediocre. The cumulative impact of these outstanding investments, alongside a mix of hundreds of others, has led to an average annual return of Berkshire that approximately doubles that of the S&P 500. So what does that tell you? As investors, we have to focus on looking for those mega opportunities that compound astronomically over the long term, instead of looking for short-term profits. And always remember that if you're troubled about a stock that you own, then you likely shouldn't be having it at all. Moving on, have you ever noticed how a lot of asset classes come down to only a few really good decisions with high conviction over an entire career? Opportunities like these never come every other day. Here's a really interesting take from Charlie Munger on the Acquired podcast.
As you reflect back on, one of these few great companies in a lifetime that you should bet big on, what advice would you have for David and I as young partners looking for a few of these in our lifetime, things to look out for?
Well, when you find one, you may find it 5 years after you bought it, These things may work into it, or your own understanding may get better. But when you know you have an edge, you should bet heavily. You know you're right. And most people, they don't teach that in business school. It's insane. Of course, you got to bet heavily on your best bets.
His ideology is simple. Be patient and wait for the best opportunity. When that slight, once-in-a-decade opportunity finally comes up, you have got to bet heavily on it with a sky-high, unshakable conviction. Because if you don't, then you may as well not even bother at all. Now, you're probably wondering how the average investor can develop that rock-solid level of conviction to know that you're making the right calls, aren't you? Well, thankfully, Charlie Munger has another piece of advice for us.
And how do you develop that level of conviction to know?
You work at it. You do a lot of reading and thinking and visiting.
Just in case you hadn't noticed, that's exactly what both Berkshire managers, Warren Buffett and Charlie Munger, do. As a matter of fact, they've been doing it for decades. Unlike most investors, these guys don't just stay at home or in an office making millions of trades yearly. They have to patiently wait, analyze, and reflect on their decisions before making any big move. It's safe to say they weigh the pros and cons of their financial decisions before rushing into anything. How about we consider Berkshire Hathaway's recent investments in Japanese trading houses? In the summer of 2020, Berkshire Hathaway revealed investments totaling $6 billion in 5 Japanese trading houses. While this move was particularly notable, as Buffett and his team are renowned for favoring American companies like Apple and Coca-Cola, Charlie Munger believes the opportunity was too good not to take advantage of. On the Acquired podcast, Munger talked about it, and here's what he had to say.
There's been a lot of discussion about Berkshire's investments in the Japanese trading houses.
Well, that is a no-brainer. Something like that, if you're as smart as Warren Buffett, maybe 2-3 times a century, you get an idea like that. The interest rates in Japan were 0.5% per year for 10 years. And these trading companies were really entrenched old companies. And they had all these cheap copper mines and rubber plantations. And so you could borrow for 10 years ahead all the money, and you could buy the stocks, and the stocks paid 5% dividends. So there's a huge flow of cash with no investment, no thought, no anything. How often do you do that? You'll be lucky if you get 1 or 2 a century. We could do that, nobody else could. It looked attractive at 0.5%, but you couldn't get it. But Berkshire, with its credit, could. And the only way you could get it was be very patient and just pick away at little pieces at a time. It took it forever to get $10 billion invested. But it was like having God just opening a chest and just pouring money into it.
Also known as the Soga Shosha, Japan's trading houses are similar to conglomerates, engaging in the trade of various products and materials. By importing metals, textiles, food, and other goods, they played a crucial role in propelling Japan's economy onto the global stage. While some investors have criticized these trading houses for their intricate operations and increasing exposure to international risks as they expanded globally, a seasoned investor like Buffett, who dares to look at the long term, he can see an amazing opportunity in diversified operations, their high dividend yields, and substantial free cash flow. All of these and probably more are why Charlie Munger insists Buffett's surprise bet on Japan during the global pandemic was a once-in-a-lifetime chance to make a boatload of money with virtually zero risk involved. Not a lot of people know this, but Berkshire Hathaway had a unique opportunity to issue yen-denominated bonds at a low interest rate at 0.5%, and then use the raised capital to invest in Japanese trading houses, generating around 5% in dividends. This rare and favorable situation highlighted a strategic financial move by Berkshire. As Charlie noted, they had to exercise a lot of patience before grabbing the golden opportunity with both hands. Over the years, you must have heard how Warren Buffett and/or Charlie Munger talk about how much they love the Apple company, and why buying its stocks was an amazing business opportunity for the billionaires. But have you ever wondered why? Because when you look at it, they're not even tech people. What exactly about Apple gave them the conviction to bet so big? Here's a perfect, concise answer straight from the horse's mouth.
To create hundreds of billions of value, that to me sounds hard, to pick the one. How did you guys pick the one?
We couldn't find anything else.
Was it valuation or?
Yeah, it got cheap. We got it to about 10.
The logic behind Warren Buffett's acquisition of Apple stocks is rather simple. Early on, they managed to deduce that out of the biggest tech stocks in the world, and we mean the top 7 or maybe 10, people generally needed to do business with at least 2 or 3 of those firms. Then here's where things get interesting. Each of those companies has incredible moats, a large presence in the market, and crucial day-to-day products for our modern lifestyles. But when you look at things from a historical PE perspective, things start to take a different direction. In the PE values of those big tech firms around 2015, when Berkshire Hathaway acquired stocks in Apple, something peculiar was happening between the lines. Amazon's price-to-earnings ratio was remarkably high. Google and Microsoft had PE values in the 20s or 30s, and Meta's price-to-earnings ratio was already well over 50. But what about good old Apple? Despite the fact it actively competed with market shares alongside the other aforementioned companies, Apple's price-to-earnings ratio was notably lower, ranging from 10 to 13 times earnings. And that, guys, was the moment of truth. It was an uncommon but significant opportunity, and as a result, Buffett invested around $30 billion in it. Can you even blame him? It was a golden opportunity that he knew would make a lot of money in the future, and he wasn't simply going to let it pass. His $30 billion position in Apple is now valued at approximately $180 billion. Just think about that for a second. In challenging market conditions with unfavorable interest rates and increased competition in the investment landscape, it's crucial to adopt Berkshire's selective approach to investing. There's really no need to always actively invest in the market at all times, as patience is your best bet to find golden opportunities. The thing we love most about value investing is that it offers everyone a fair chance to make a lot of money. By being patient and waiting for amazing prospects, you can rest assured that you'll be in the best state of mind and finances when the big move comes. Another thing that we'd like you to note is that, contrary to what a lot of analysts might have on the future economic climate, always have it in the back of your mind that there will always be a key to unlocking your financial freedom. Even though we're in a much harder environment to make money at the moment, thanks to the crazy rates, oversaturation, technology, and competition, new things will come along. It may take time, but it's almost inevitable. As a matter of fact, Charlie Munger was asked if the golden era of value investing was over, and this was his amazing response.
And I was just wondering, do you think the golden era of investing is over?
Well, not forever.
Why?
Well, because I think it isn't like the last recession or the last big opportunity that the world is ever going to get is past. There'll be opportunities in the future. There are times that are easier and there are times which are harder.
Despite the current overcrowded market and the tendency for individuals to follow the crowd, there are still appealing opportunities that arise from collective human behavior, whether driven by greed or fear. As smart value investors, all we have to do is do research on a few high-value investment opportunities that could build our wealth astronomically, and wait patiently for the right time to strike.